All right, Bloomberg News is reporting that the SEC has begun taking a close look at Goldman Sachs' failed plan to offer Facebook shares to its U.S. clients. Now, the question is, would such an offering have been fair according to U.S. securities law? But securities law isn't supposed to be fair. It isn't supposed to level the playing field, and not everyone is equal under the eyes of the Securities Act of 1933. And that's the problem that has piqued the ire of the SEC. Goldman Sachs had proposed offering shares of Facebook to people who might be ill-suited for Facebook's stake, or did they? Here's the crux of it. U.S. securities law says there are two kinds of people and rich people. When companies sell stock to most people, they have to issue quarterly and annual reports detailing all sorts of financial information so that lots of people can know just what the company is selling. But the Securities Act of 1933 also established a distinction for so-called sophisticated investors. Investors accredited as sophisticated can make riskier investments in companies that won't release all their financials. Now, who's sophisticated? Well, lacking a better proxy, the Depression-era lawmakers decided that rich people were sophisticated. They didn't know about Donald Trump back then. Now, just how rich is rich? Well, those limits were adjusted last in 1982. So anyone with $1 million in assets, not including real estate now, or someone with $200,000 in annual income in each of the last 2 years, an expectation of $200,000 in this year's income, or a family with $300,000 in annual income, they're considered rich. Now, that's getting to be a big list. According to the Spectrum Group, 8.4 million American households had more than $1 million in assets. It's about 8% of Americans, yes, 8% of Americans are millionaires. And that 8.4 million people, that's up 600,000 from 2009. So if nothing else, the rules that were aimed at preventing secretive fledgling companies from offering shares to the public. But as the rich get richer, and the definition of rich is now 29 years old, those kind of secondary offerings are available to lots of people they may not have been intended for. Now, let's drill down on this a little bit deeper. I want to bring in Robert Bartlett, who is a professor at Berkeley and an expert on SEC law, who can talk about some of these sky-high valuations, how they've attracted both investors and now the SEC. What is it about these offerings that's caught the SEC by surprise?
I think it's a couple of things that is concerning the SEC. On the one hand, the SEC has a mandate to protect investors, and so I think they want to make sure that in the frenzy that is currently happening in the secondary markets, that the investors are in fact getting the information that they need in order to assess whether these are valuable investments.
But the whole idea is that not all investors are equal, that sophisticated investors should go get it themselves or not, and if they lose their money, tough luck, they're millionaires.
Well, that's the idea. And ideally, if you have sophisticated investors, they'll know what to ask for, and then the private markets should work actually fairly appropriately. I think the concern with the SEC is that perhaps the proxy of investor wealth is maybe breaking down, and therefore the need for mandatory disclosure is perhaps necessary in these particular markets. It may be possible as well that they're not accredited investors after all. Maybe people are just lying on their applications, getting around the accredited investor limitation.
Well, and it's not so high a limit. I mean, $200,000 a year is a ton of money, but it's not, I mean, F. Scott Fitzgerald's misquoted line, the rich are different than you and I, they have more money. Maybe they're not so rich.
Well, I'm a public university professor, so I may differ on what exactly is rich, but your point is well taken. In fact, in 2007, the SEC did consider adjusting these thresholds to account for inflation. Financial crisis hit, and that was basically postponed and has been, in some sense, displaced by the Dodd-Frank Act.
But was it postponed because they thought that $200,000 is rich and therefore sophisticated in terms of annual income? Or was it postponed because they couldn't get around to it? Or was it postponed because some people wanted to make their offerings available to a lot more people?
I actually think it was a more pedestrian reason, which is that the Dodd-Frank reform bill was so broad that Senator Dodd actually had it as on an agenda item as to address the accredited investor definition, and actually tried to raise both the asset level and the income base, but was pushed back significantly, in particular by angel capital investors. So angel capital investors want to let people invest in hedge funds, and they're angel funds, people without a lot of money. Yeah, or just the angel investors themselves want to be able to continue to invest in promising technology firms. The argument was that if you increase the threshold to 2.3 million, which was what Senator Dodd was proposing, that would eliminate a large number of angel capital investors from the marketplace and thereby hurt sort of early stage financing.
Now, we talked on the phone this morning about tea leaf reading as it relates to Facebook filing for an IPO. And there was speculation that when they said they're going to file their financials by next year, that means an IPO is coming or not. Talk to me about when you saw that news, what does that mean? Well,
it was interesting I found it interesting that Goldman announced that deal at the turn of this calendar year.
They did not announce it on the 31st of December last year.
Yeah, I don't think that was a coincidence that it waited until the beginning of this year. And the reason is that Facebook, to my understanding, is on a calendar year, fiscal year. And so if they exceeded 500 shareholders of record, which is the current limit on how many shareholders you can have as a private firm, then they would be obligated to file public reports within 120 days of the end of the current fiscal year in which they exceeded.
So the year at which they crossed 500, the next year they have to report, or early in that next year?
120 days after that, yes.
So when they say they're going to give their filings by March, all that means is they're going to cross that limit during March of 2012. During at some point in 2011, they'll cross that 500 threshold.
That's exactly the case, yes.
So maybe that was their plan all along.
It could have been, yeah. And in fact, what it ultimately had Goldman restructure the deal was concerns about whether or not they may be engaged in a general solicitation, which would then potentially invalidate the private placement that they were trying to achieve.
And I am going to finish your paper on going private and staying public and the implications of Sarbanes-Oxley, but not right now. Robert Bartlett, thank you for joining us. Really appreciate it.
My pleasure. Thanks for having me.